What's up, everybody? Michael Silva here to do some technical analysis on the financial markets. This is where we get a really good picture as to where the stock market might be heading next. Today's episode is a very important one, so if it's your first time here, buckle up. It's about to be a bumpy ride. Let's get into it. All right, welcome back to the show. I want to first kind of sector this off and tell you what I'm going to be talking about in today's video. We're going to be breaking into a few segments here. We're going to start off with some indicators, mainly around breadth indicators and sentiment indicators. We're going to kind of get a good idea as to where, from a contrarian point of view, are we overextended? Are we underextended? Are we overbought? Are we oversold? What's the market thinking? What's the market doing? Once we get through that, we're going to then look at the indices, so S&P 500, the NASDAQ, the Russell, and the Dow. From that point, I want to take you over to some sectors that are kind of just on my radar. Now, I've heard few analysts talk about these sectors for being just amazing opportunities in these sectors. They've been performing really well, but I'm seeing something that kind of says, hey, let's pump the brakes here. So I can't wait to get into that with you. And I'm going to put these in the timestamps below. Now, to save me time when I upload the video, the timestamps are going to just be broken up into segments. So I'll have, segment 1 will be the indicators, then 2 the indices, then the sectors. And then on the last segment, we're going to talk about yields, commodities, and the currency, the US dollar, a very important chart. So it's an overall intermarket analysis that we're going to be going into. Now I'm kind of rattling off. Let's just hop right into the episode. The first chart that I want to talk to you about is the NASDAQ 100 bullish percent index. This is an indicator. It's based off point and figure charts, and what it tells us is, really quickly, without getting way into the definition of what this index or what this indicator can be used for, you can Google it if you'd like to see more, how in simple terms, when it's above the 50 marker, okay? When it's above 50, that means more than 50% of the stocks are on buy signals, according to point and figure charts. When it falls below, that means that there's more sell signals. How do I use this chart? Well, I look at it as overextended moves, so when everything's way too bullish or way too bearish. So on the overextended moves, that's when I'm like, okay, it could be time to pump the brakes. So I use it kind of as just a contrarian indicator, sentiment, see where the market's at. Where we're at right now is at 84%. What does that mean? That means that 84% of the NASDAQ 100 stocks, so that index, 84% of them, according to point and figure charts, are bullish. So that's a huge percentage. 84% is all bullish. When the market gets super overextended, that could be a time to say, hey, it's probably not the time to go long at this particular point in time. Now, when things get underextended, you could look at this, oversold, you could look at the RSI here. We mapped this out quite some time ago in September, and it put in a low here and then a higher low there. If you go up to here, this is the NASDAQ 100. It was kind of building in this low thing, and that to me was a bullish divergence. And even on the indicator itself, it had a low here and then a lower low here. That was a positive divergence. The price action was going down, but the RSI was telling us, hey, no, there's strength being built here. And what did we see take place? Well, we saw, from a technical analysis perspective, we saw the falling wedge, and we mapped out, hey, this could be breaking out. Then it formed the inverse head and shoulders, which we'll talk about later, and then it continued that breakout. So what's going on right now? Well, one, we are getting pretty frothy at 84, okay? So 84% is pretty darn high. Now, that doesn't mean that it can't stay up there, okay? That does not mean, oh no, the market's gonna collapse. That is not what it means by any point. But this is something to take note of. When you see sharp declines, that could represent, hey, the market is, this move to the upside is probably pretty weak. And what we saw was this sharp decline and then sharp incline. And now we're kind of just waiting, hey, is it going to hold up here or is it going to come down? When you look at the RSI, this is where it gets interesting. The RSI is now getting into overbought territory, 71.33. So it's going to be interesting to see what takes place. Now, if we kind of move up a little bit higher, I wouldn't mind that actually. And then what would be interesting to see is it come down and then potentially have the price of the bullish percent index even go higher and then create a negative divergence in the RSI. Now, it could still do that from its current point. So we're going to be mapping this. If it creates a negative divergence, whereas we put in a high here and then a lower high, and this goes from a low high to a higher high, that could signal to us, hey, that happened over here. From the flip side, it was a bullish divergence. Then it would be a bearish divergence, which could be bad for the NASDAQ 100. But we're going to get into the NASDAQ 100 chart here shortly and talk about why this looks like a time that you might want to pump the brakes. It seems to be more of a risk-off move. Like I said, buckle up. Today's episode is going to be probably pretty long. We're talking about a lot of things. So let's go to the next chart. This chart is the NASDAQ 100% of stocks moving above the 200-day period moving average. So what does that mean, Mike? That means that on the axis over here, that is the percentage point, and the percentage that it's at is at 90. So that means that 90% of the stocks in the NASDAQ 100 are above the 200 period moving average. Look back through the history of this chart. I'm going back past to 2016. Now, this is a weekly chart. So, but if you look all the way back to 2016, there's nothing even close to this range. And when we get way up here, that could mean that there's a lot of stocks that are overextended in their moves or way past the 200 period where we might be seeing some sort of contraction. Do you understand what I'm saying about now? We're using these as a contrarian indicator. This is strength. So we're seeing strength. This is a good thing to see for the bulls. However, if you take a different viewpoint and you look at it from a perspective of, well, it hasn't really been there. And sometimes when it gets really overextended like this, you can look at individual stocks and they might be overextended where you're coming into a territory for some sort of a pullback. Like I said, we're going to be looking at the charts, the NASDAQ, the other indices, and we're going to be seeing like, okay, are they overextended right now? Or is this just saying, hey, no, this is bullish right now. This is very bullish and it's good. So boom, this is the 200 period, or sorry, like I said, the NASDAQ 100 over the 200 period. Now you can look at this for the S&P 500, you can look at it for the NYSE, you can look at it for the Dow Jones. I just brought up the NASDAQ 100 because it's more of a popular one, but by any means, you can look up the other ones if you would like. Let's go to the next chart. This is the NYSE, or it's called the NY High Low. It's the High Low Index. And this is, all these are lagging indicators. Let me mind you, these are lagging indicators. Nothing tells the future, but what we're using these as, we're using them as indicators that can tell us if something's way overextended or way oversold, or, we're just using it as, we're taking note, but we're putting the pieces all together, okay? And it's gonna all round out into the conclusion at the very end. Where are we here? So this is basically saying, based off the 52-week high-low, 93 is a very high number, right? We're moving into a very, very high extreme. This, the black lines behind us, that is the NYSE. And what's interesting here is there's still a big gap open up here from March, and the price action has not made a new high like the NASDAQ 100 has, or cleared the high, and various other indices. So the NYSE has not showed as much strength as the other indexes, but what we're seeing here is just this very, very big spike to the upside, so it's showing some strength. However, when we sometimes get to these over extreme levels, we can see pullbacks. Now, the high low, it can stay up there for a very long time. But like I said, it's something to note. It's something to say, hey, okay, most of the stocks in the NYSE, which is it's 2,000. I think it's 2,000 individual stocks that make it up. So it's a big piece to the economy. This is a very important index. It's basically saying, okay, well, we have a huge percentage of stocks making 52-week highs. So the index is at 93.05. So something to take note of. Could mean that those 2,000 stocks, a lot of them are being very overextended at this particular point in time. And if there are some very big ones within it, we could be potentially seeing a pullback here in the near future. So what I'm trying to preface here is we're looking at certain indicators. We want to see what's taking place in the markets and kind of just progress forward. Now, there's going to be opportunities for all the bulls out there. There's going to be opportunities for all the bears out there. But what you don't want to be is a pig, because as you already heard the saying, bulls and bears make money, but pigs, they go to the slaughterhouse. Let's look at the next indicator. Here is the CPC, smoothed over the 10-period moving average. If you watched yesterday's video, this was the thumbnail. I was discussing that this is the warning sign, not the sell signal, but it's the quote-unquote warning sign, and we saw it hit 0.8, dropped just right under it today. I mean, I think it's still right around the 10-period moving average is at 0.8. I don't know, maybe it just didn't fully load, but that is the warning signal. We saw a little bit of a pullback today. The sell signal, and let me reiterate this, the sell signal doesn't mean go buy a bunch of puts that are short term and get burned by theta. That's not what that means, or gamma, or whatever, which is going to just destroy those positions. What it means is you want to make sure you have stop losses in place, be comfortable with what you could lose. You want to either hedge your long positions or just take some profits off the table, or maybe reduce the amount of risk, or start moving into risk off type assets. You can be risk on, you can be risk off, or it's really your decision. But when it comes into these kind of sell signals or way overextended moves, it's not the best time to go long. I mean, it's just not. Why go long when things are at its very peak, overextended? It just doesn't make sense. But people that don't read charts, people that don't look at charts, people that don't look at indicators, breadth, sentiment, if they don't do intermarket analysis, they don't know this. So good for us. We know a little bit, I guess. And there's a lot that I don't know. So, it is what it is, and I'm constantly learning. But we cross here below 80. That is the warning signal. We had a little bit of a down day today. What we need to wait for is a cross back above. That would be that when we start contracting and doing a little risk off. Now, me personally, I'm already risk off. So I do, when I see some good trade setups and it's a high beta, which means it's a higher risk, it's more volatile of a movement, I'll just lower my position size. That's all I do. So, okay, so that's the CPC. If you want to hear more about that, what this actually is and why it's important, just go to the previous video, previous market brief. It'll be there. I believe this is the last indicator that I want to show. This is the NIMO McClellan oscillator. And what we got going on, here's the oscillator right down here. We got the red, black, it's a histogram. Right above us, we have the S&P 500. And what we were looking at was the familiarity between 2018, late 2018, to right now. And it was basically, what we were saying was the market was making these just extraordinary highs, but it was doing so on a negative breath. And then we saw this big down pull. And what we're seeing here is, like I said, we're making new highs on a negative breath. And then we see this very sharp spike to the upside. And that sharp spike brings the market a little bit higher. And now what we're seeing is it was at 60 the other day, and now we're at 30.17. So that's a pretty steep decline in this breadth indicator. So if we start moving back into the negative breadth, it could be very, very familiar to 2018. And right here, you can just look at 2018. It was right here. So we saw, just like we saw here in September, right? We saw the down pull, then we saw the breakout, and it almost, kind of got right up here around the 618 fib level, and then it spiked down. You can see the NIMO spike to a negative breath, and that was pretty much game over. We saw it kind of chop back and forth, but it really came down here to 2,350 right here. So just very, very, very aggressive type moves, and it's something that we need to watch out for. It doesn't mean it's going to happen. It does not mean that. So, take it with a grain of salt, but take it also for what it is. This is not me giving necessarily opinions. This is just the data. The data is showing us this. It's fact. It is there. The market is doing it. We're just reading it. And just like if you were to read a book, I'm reading this book right now, Skin in the Game, good game, or good book. But if I were to read this book and somebody else were to read this book, and I said, hey, what'd you think of the book? And they're like, it was really good. And I'm like, well, it was really bad. We read the same book, but we came to different conclusions. Understand that's just like charts. You can look at the chart and you can say, okay, I get that contrarian point of view that Mike is talking about, but I'm really bullish right now. And being at those levels, that tells me that the market is very bullish. So you can read it both ways. You can look at the historic price movements and the spikes and how fast they move. You can look at price action, volume, you can look at volatility, and so forth to come to those conclusions. So I'm coming at you from trying to be as unbiased as possible, especially with everything that's going on in the economy, and this market keeps making new highs. It's like, it's crazy to think, but I'm just trying to be as unbiased possible. It could be very bullish because the indicators are showing us that, but they're also showing us that they're overextended, which could be bearish. So, take it how you want to take it. People always, ruffle my feathers in the comments sometimes, and they're just like, no, that's not what that blah 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 blah. It's like, okay, fine, you're just reading it differently. I'm just giving an opinion because that's all this is, just opinions. Let's go to the next chart. All right, so we are looking at the S&P 500 on the daily time frame. Now that we have some knowledge around breadth, sentiment, where this market is, how it's feeling, it's feeling really bullish. Now we're going to start looking at the technicals. Okay, the specific indices here that tell us, what's going on. And we're looking at the daily time frame. We saw this falling wedge. We broke out of this inverse head and shoulders. Now we broke out. And as you can see here, just a bunch of air pockets, right? All these gray boxes, those represent gaps. So gapped up, gapped up, gapped up, gapped up, gapped up. 5 gap ups. And then we're coming up into an area that was also a gap. So we're just surrounded by gaps, which means, just think of it as a lot of air pockets in the market. A lot of times gaps, they do get filled. And to have all of this here kind of says, hey, bubble, 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 bubble. Like, be very careful because we can have pullbacks that could be very aggressive, which, we had plenty of moves and air pockets going up previously in August. Okay, we had all kinds of air pockets in August. Guess what happened to those air pockets? They got filled. So when people say, oh, why do you look at the gaps? It doesn't mean anything. It does. It does mean something, and we just got to look at it and kind of just take it in for what it is. They're gaps. They're there. Does the market want to fill them? Maybe, maybe not. And then just be prepared for if the market were to come down. They also act as really good resistance and really good support. So let me get back on topic. We broke out of this inverse head and shoulders. I was calling this more of a short squeeze. So it was bullish pattern breakout. And then what do we have happen? Well, we have shorts cover. You have to cover. So that means they're buying the stock, which pushes it higher. Then you have momentum traders. Momentum traders are like a breakout, so they buy the stock. So what happens? The market gets pushed up super high, super fast, right? 34.20 all the way up to 35.25. This thing has some legs. It could run higher. I'm not saying it can't. However, I want you to look right here where the price action's at. Okay, we're above a gap. Okay, so this gap can act as a support, above 3,500, which is a pretty intense move to the upside. We're disconnected from the 5-period EMA. The 5-period EMA is usually connected with multiple times. Okay, when the price action goes up, you usually get reconnects fairly quickly. It's one of the most frequently tagged EMAs, and right now we're pretty overextended from it. On top of that, this green shaded area, that's known as the Bollinger Bands. We're overextended from the Bollinger Bands, or we were really overextended. We talked about it yesterday. Now we're kind of back within it, but we're still up at the higher end of that range. Now you can call this an inside trading candle or inside trading day. So that could mean for the bulls, it's consolidation. We're consolidating right now sideways to potentially make another leg higher. That's very possible. I'm not saying that it's not. I'm not trying to be super bearish. I'm not trying to be super bullish. I'm calling for what it is. Now, we're overextended from the 5-period EMA, so that can very well open up tomorrow, right? Comes up a little bit, and we might get action to pull back, and you might actually see a good opportunity to buy that specific dip if you're trying to be an intraday trader. It pulls back to the 5 EMA, we just buy into that, it fills this gap, boom, it bounces from that point, we maybe move higher. So it could be a good risk versus reward trade. If you look back over here to September, what took place? Well, we got overextended from the Bollinger Bands. We got overextended here. Where was the EMA? The 5 EMA. Well, we were overextended. We were overextended there too. And then we got this big pullback. Now, sync all of that in with all the other indicators being overextended that we talked about. The breadth of the market kind of being sucked out right now. Even though it's still bullish, it's technically moving downwards at this particular point in time. And a lot of things are overextended. So, hey, where can this price go to? That's probably where everyone wants to know. Well, first off, it was the breakout, right? Now it looks like a very spiky, just a very sharp up channel. So if we start breaking or maybe you can even call this a rising wedge. It would make sense. I think we kind of turned it more into a channel these last couple of days, but so if you draw a line from here and draw it straight up, if we start cracking below that, or if the bears recapture the 5 EMA, I think that we can come back here to test this neckline of the inverse head and shoulders. So let's call it 34.30 right there, maybe just a little bit lower. So that can offer up a really good risk versus reward type trade. I think that this breakout happened on stimulus hopes, and there's still hopes that stimulus is coming. As the days go by, I'm getting less and less convinced that it's actually coming until afterwards, some point in time. So we'll see. But that's kind of my take here on the S&P 500. This is not the area where I want to just buy long because we have overhead resistance. We're overextended. The indicators are saying, just take it easy right now. So I'm looking for just some type of pullback to a major area of support. Where is that? That's right here at this neckline. I'll probably be looking for some good trades right around within that area, and it would be just a nice tight stop loss because it could still very well go lower. I'm just looking at the more major area would be that breakout area. Okay, so that's the S&P 500. This is the VIX. The VIX inverse head and shoulders. This is the volatility index. This tells us, hey, it's kind of an inverse correlation, right? It is an inverse correlation to the S&P 500. If we start seeing movement to the upside in the VIX, it's going to apply a lot of pressure to the S&P 500. We saw it uptick today. We recaptured the 50 period, and we've been kind of tagged within this channel for quite some time right now. Okay, so we've been 30 basically. We can't get above 30, and we haven't been below 22.7 basically. So this just tight channel here, and now we're kind of seeing a move. So if we start moving back up to 30, that's going to apply pressure to the S&P 500, and that could even potentially bring the S&P 500 down to that neckline. Now, it depends on the move. If it's just small moves every day, that could just be building more to this pattern. But if it's one big spike to the upside, then yeah, that's what's going to create a lot more volatility in the S&P 500. So we got to keep an eye out. This pattern is still forming. It's still active. We'll keep an eye on it. Now I'm going to get into the NASDAQ 100, and then we'll talk about the Russell and the Dow. I'm going to try to move a little bit quicker here just to reduce the amount of time that I'm doing this. It looks like the same chart, right? It looks like the same chart. However, the NASDAQ 100 is clearly still overextended on the Bollinger Bands, significantly more than the S&P 500. We have a gap below us. We have a gap above us, and we're overextended from the 5 EMA. This, to me, is an overextended move. It looks like very shortly here, we're going to be seeing a pullback. The market's going to bring in some scare. We might have a couple little bounces right here. It could be just coming into a consolidation period. As of right now, though, you don't want to go long because, one, you could get lucky and maybe you get a little bit of an updraft, but you got to understand that when it comes to trading long-term and being successful, you want to, number one, pay attention to your risk. And right now, there's a lot more risk to the upside than there is to the downside, meaning that, hey, if you want to go long right here, you're basically risking a whole lot to earn maybe just about this much. It doesn't make sense. You want to wait for pullbacks to main areas of support, or if you're familiar with how to short market, advanced options strategies. I don't really talk about all that stuff too much, maybe one day, but if you're not familiar with that, probably just don't do it. Maybe just educate yourself, learn it, start very small, and then build strategies that you're comfortable with. It's, everyone's different in this world. So that's the NASDAQ 100. It looks to me like it wants to still snap back. Currently just kind of consolidating below 12,200, and we have resistance just right up ahead. Here is the Dow Jones. Very quickly, we did contract back into the Bollinger Band, so that's a decent sign, but we're still overextended from the 5-period EMA. It's been multiple days that we've been above it, still at the upper range of the Bollinger Bands, and we're kind of almost crashing up into the all-time market high. It wasn't that bad of a day today, to be quite honest. I mean, if you look at the previous day, we had this gap down, moved a little bit lower, bounced a little bit. But overall, scoping out, we are still within this up channel. So if we start cracking below it, it's going to be another one of those things like, where can we potentially bounce from? That's going to be around 28,000. It's very possible that we break through this. Now, when we look at some of the other sectors, when we get into that, for example, the transport sector is very important. That makes up it just makes up a big portion of various indices, and especially the Dow. We're going to be looking at the Dow Jones Transport Index, and that's a big one. So if that goes down tremendously, we can see it pull down the index as well. So we're going to talk about that here very shortly. Let's go ahead and look at the Russell 2000. Here is the Russell 2000. We were overbought in the RSI. This, to me, I was like, yes, if I was going to short any index, it'd be this one, because this one closely resembles the economy. We're talking, small cap stocks. We've been seeing this nice move to the upside, which is good for the economy. However, we're running into this area of resistance, and there's a big gap right here from 165 to 162. So it really depends on how the Russell can hold up within this gap. If you just look back here, it closed here and then opened way down here. I guess technically that would be a fill and close. Yeah, I guess so. But still, there'd be resistance up in this area right above that upper wick. So it's going to be interesting to see how the price action interacts with all that stuff. Mind you, we have OPEX week, so typically that's bullish. So we might still get some moves more to the upside. It's possible, but it's also very possible that we start getting some moves to the downside because of all these overextended signals that are kind of just saying, hey, slow down a little bit. So we'll see. And by the way, when things get way overextended, like I've already been saying, for the bulls perspective, it doesn't mean that a crash comes, okay? Let me reiterate that again. It doesn't mean that a crash comes. It could mean that we're going into a period of consolidation or, slightly dragged down. So, for example, when it came up here, right, the RSI got oversold, we consolidated. Yeah, we drafted a little bit lower, but then, boom, we just saw that big move to the upside. So that could be something that happens, okay? For all the bulls out there, just calm down, all right? All right, so that was the Russell 2000. That was actually all the indices that I wanted to talk about today. Let's get into the sectors. I'm going to be talking about, I think, 2 sectors, okay? Let's start with the SOX. Here is the Semiconductor Index, the SOX. And why am I bringing up the semiconductors? Well, first off, the NASDAQ composite, the semiconductors make up a big portion of the NASDAQ composite. So when you see semiconductors do really well, the NASDAQ can do really well. However, if you see the semiconductors really struggle, you can see the NASDAQ also really struggle. Makes up a big portion for it. So why am I showing you this? Well, first off, the NASDAQ 100, the NASDAQ composite, they've been doing really good along with everything else. Stocks only go up, right? They only go up. But what do we got going on? I want to point out divergences and why they might be important. Now, I don't have this huge study. You can go back through history. I'm only going back a couple of years, or basically 2 years, right? I'm going to 2019, 2020, and then also, just a little bit more data back there. But when I find divergences, they typically act correct. So what do we see here? RSI. We saw a low here and then a higher low, okay? Well, if you look down at the price action, you saw a lower low, and then right here, it was obviously a little bit higher. So what does that mean? Positive divergence. The price action is moving down, bearish. However, the market is saying, you know what? This market could move higher, right? And people say, no, this is a lagging indicator. It's lagging when you look back through history, but it's also a signal ahead of time. And I'll tell you why now, and I'll prove it later for the next person that ever says that. This is telling us that the market sees the potential that it can go higher. What happened? Well, the market moved higher. What do you know? Does it mean that it always takes place? No, this can actually continue to head lower. It can, right? I mean, you got to look then into other indicators, breadth, sentiment, technical analysis, patterns, etc. People always forget that. You don't ever hang your hat up on one indicator. It's pointless. Over here, bearish divergence. The price was going, almost even, but a little bit lower. The price action was moving up. What happened? Well, we saw this move to the downside. All right, nothing big. Then over here, what happened? Well, oversold right here. Then it kept on bouncing. It was kind of on this trend line down, so it was creating lower highs. And then down here, we were making higher highs. What happened? Boom, crash. If you were paying attention to this, you might have been like, okay, I got to get out of semiconductors. And what do you know? How was that March crash? What do we got going on now? Well, first off, this big old spike brought us in to oversold territory. Now the price action is clearly higher. So negative divergence. Does this mean that they're going to just crash? No. This semiconductor index could head higher, which then it would take away this divergence if it starts moving past this level on the RSI. But as of this particular point in time, it is a negative divergence, which means bearish, overextended move way above the 200 period, way above the 50 period. If the semis start taking a steep move to the downside, that can apply a lot of pressure on semiconductor stocks, obviously, and also the NASDAQ, okay? So we're looking at breadth and sentiment indicators. Now we looked at the technicals. Now we're looking at some of the sectors that are important, okay? So that was the SOX. That was, negative divergence. What do you know? Let's look at the transportation index. Here is the Dow Jones transportation average. Once again, I'm going to try to go through this a little bit quicker. Bearish divergence, super oversold, really frothy, and then obviously the price action moved higher. So a high here, low high here, lower high here. Notice the RSI going down, the price action going up. The market could be saying, hey, you know what? This move is over, or it's not as strong as we all think. What happens when the Dow Jones Transportation Index starts going lower? That applies a lot of pressure to the stocks that make up the index. We're talking about airline stocks. Airline stocks, also there's an airline index you can look at. And airline stocks have been kind of just on the sidelines waiting for stimulus, and they've been just tracking sideways. Today, there was actually a pretty big hit because, well, one, there has been no stimulus. So the Dow Jones Transport, if we start seeing this really start moving lower, and this does hold up as a bearish divergence, we can see it move, obviously, potentially even down to the 50-period moving average, which is going to apply a lot of downwards pressure on individual companies. If you look over here, this was the last bearish divergence that I wanted to point out. It was a low high to a higher high, and then the RSI was saying, yeah, this move doesn't look that strong. And then boom, just from up here from 11,178 down to 9,734 practically, so maybe even lower than that. Yeah, it was just a big move to the downside. Keep in mind, if you're buying individual stocks, you probably don't want to buy transportation stocks right now. Probably stay away from the airline stocks. Now, airline stocks could be a little bit different. They're kind of on the sidelines waiting for stimulus. If stimulus comes, that could be very good. Oil price has been going down until today, which we talked about yesterday. Oil has been going down, which is good for the transportations, right? What did I show the other day? Let me pull it up. Here is a sector. It's the oil index over the transportation index. And basically that means when the oil index goes lower, or when this line, goes lower, that means that the oil index is underperforming the Dow Jones, which transports. So what does that actually mean in more clear terms? It means that when oil prices contract, when they go down, that's good for transportations. Why is it good for transportations? Well, simply because that lowers the expenses that transportation index use. They use a lot of oil, so that's a good thing. And we're seeing the sinking energy sector and oil. We've been seeing it go sideways to down. XLE, which is the spider, we've just been seeing that whole sector just getting torn to shreds. And that's going to be a sector that will eventually show some strength, and it's going to present some great opportunities. So I'm keeping my eye close on that sector. Even this right here, though, look at what's taking place. Well, we're seeing a positive divergence. The MACD is clearly positive, the RSI is clearly positive, and the price action is much lower. So that means, hey, the tables might be turning here. Dow Jones Transport's going to be heading down, oil going to be heading up. Speaking of oil, we're still trading within this channel. Positive divergence on the RSI, and is kind of like a double bottom right here. So if we start breaking above and breaking out of this channel, that could be a very bullish sign for oil. Now this is just WTIC. We're looking at light crude. So still kind of pinned within this range, but it's something to take note of, keep an eye on. If oil starts performing and starts doing really good, well, we're going to then look into the energy sectors and oil stocks, because those will start performing and obviously doing very good. Now, I didn't transfer off into commodities. This is a commodity. So let's now go ahead and obviously talk about the other various commodities. I want to first start off with gold, then we'll talk about silver. Then I think I'll just leave it at that for the commodities. So horrible day for gold. Just the other day, everyone was getting so excited about this breakout, and we're over here talking about, it doesn't look that great. I mean, it was a good breakout, but still looked weak. It was still below the 50-period moving average, and yeah, it broke out of this trend line, but it just looked and felt fake. Well, what do you know? Today, down 1.78%, $34. Boom, crashed lower. Maybe this might change. Maybe it won't. That doesn't look good. This whole 3-candle setup right here does not look good. Big bullish day. Then we had this move up. And then there's this gigantic, just fully engulfed candle to this previous, well, not the last day, but the previous day. So very, very bearish action for the price of gold. Has a lot of work to do. I think that if we start cracking below, obviously, 1850. I mean, there's a couple levels here, right? We have 1880 and then 1850. If we get below that, I think we're testing this 1815 all the way down to 1770. It's very possible. What made gold fall? Well, we'll get into that chart here soon. Let's first look at silver. Hi-ho silver. You know what's funny is I'm pretty sure on yesterday's video I was like, I wouldn't go long here. If anything, I'd be shorting it. What do you know? Down 4.52%. Why was I so confident about that? Well, first off, the indecision candle at the top of this range, below the 50 period, to me that looks pretty bearish. It just could have break out. Obviously it could break out, but it didn't look good. This little setup right here, that's an evening star. I forget the name of it, but this pattern, the psychology is telling me, hey, we're doing really good. We're doing really good. Psych. That takes a lot of confidence away from the bulls that work so hard to get it up there. So we haven't broken below this, but if we start breaking below, I'm looking at the 200 period moving average as the next level of support. Let's quickly talk about yields. Now, this is a new chart. I'll walk you through it really quick, and I'm not going to give this whole history lesson on yields. They could get very complex, but the bond market is very telling, and it's a very important market to understand. I mean, I'm not even a bond professional by any means. I'm not a professional in anything, to be quite honest. I understand basics, and I try to keep it very simple, and that's how I kind of go about the markets and trading. This chart that I put together shows all kind of yields. We have the 30, the 10, the 2-year, and then the 3-month. Then down here, this one is the 10-year minus the 2-year, and then this one is the 10-year minus the 3-year. These are good for spotting inverse yield curves. So when these curves go below 0, that means the yield curve's inverted. So over here in February, you saw, or early, actually even I think if I scoop back even further, which I haven't, I mean, but you can, if you pull the chart, the link in the chart below, if you pull the description up and you click the link in the description about this yield chart, oh my gosh, I'm losing it. You'll probably see it happen a little bit previous to this, but clearly, this means that it was inverted. This was during all this panic, and then just rates got slammed. The lower rates really follow the Fed's funds rate more closely, and then the market kind of tells us where the 30 goes and the 10. That's a brief overview, but what's going on here? Okay, back to my point. Well, first off, the 10-year yield had a huge drop today, over 6%. The 30-year is down 3.8%. So both got pretty, they just got hammered today. And look back in the history. Look at the blue line, actually. This is the 10-year. This is, I like looking at the 10-year. Big spike here, big spike here, spike here. Each one of these spikes are lower. Okay, and like I've been saying that this looks like a bullish trade, bearish trend. What does that mean? What does this big move down in yields mean? It's very possible that this could be the risk-off move. And if it's anything like this where we is the spike and then the move down, spike, move down, spike. If this is the move down, that means that people are going to be moving into bonds. And, you can look at 10-year to 20-year. You can look at certain, notes, etc. But really what that is saying is, hey, this is a risk-off move taking place. And what do you know? One of the sectors that has been performing the best has been the utilities sector. The utilities sector is typically a risk-off way to invest. It's lower beta stocks, it's necessities like energy and water, and that's where money flows to in uncertain times. So what do you know? We're seeing this downdraft right here. Don't consider this and come to the conclusion that the whole world's over, but geez, I mean, it just doesn't look good. Now, the higher the yields go, the higher this moves from this zero line, that's good for banks, right? When this goes up, that's good for banks. Why? Because they lend in the short term, they borrow in the short term and they lend in the long term. So that means basically they can pay close to nothing with a 0% interest rate, and they make money on the higher rates. Now, relatively, these rates are all really low, and seeing the move lower kind of is a little bit of a concern for a lot of things. I mean, a lot of people and a lot of things. This low rates, let me write it off even easier to understand. Low rates does not encourage savings. No one wants to save money if they're not going to make any money on their savings. What it does is it encourages spending and, maybe getting overextended in certain levels of debt. Look at the housing market, right? When the housing market interest rates are really low, what do you think takes place? You get all these refinances. You get people over and outbidding you on homes that cost $300,000, but yet they're willing to pay $350,000 because the interest rate is low. It encourages speculative behavior, and when rates have to go up, or the market forces them up, or something takes place, it's devastation. So from a personal standpoint, when you look at yields and you're like, hey, debt's a lot cheaper than usual. If you are using that debt to consume, you might want to pump the brakes on that. It's not the greatest investment. If you're using debt as capital or to spend on something that produces something for you, you won't find debt this cheap. So it's pretty insane. It's pretty amazing. It's just, how are you going to use it? You can get over leveraged with this cheap debt and you can get destroyed, but you can use it as a tool if you understand and if you're smart like that. I'm not the greatest person at real estate, but this is just a little history lesson here. All right, let's move to, what do I want to talk about now? I don't even know what I want to talk about. I think that's it. I went silver, gold. Here is the US dollar index, and what do we got going on today? Very bullish day, yes. Up 0.43, captured the 50-period moving average. This is somewhat of a reversal type looking pattern here. This candlesticks that I'm kind of circling around. Yeah, this is still in its basing formation. This is still considered a cup and handle. Can we move higher? Absolutely. It's still, though, technically, we're moving sideways, but we're seeing some strength here in this handle. Now, if it keeps going heading lower, that losing more and more conviction that the dollar has some upside. A lot of analysts, a lot of very smart people believe that the dollar will spike higher in the short term, but they ultimately see the dollar getting weaker and weaker as time continues with all that's going on in the economy. So what we want to see here is, one, a breakout of this line right here, this horizontal line. That could shoot us up 96, maybe even up to the 200-period moving average, and then we could see some resistance there. That's going to apply a lot more pressure on gold and silver and various other commodities. So we're going to have to monitor this one closely. If it starts moving lower and lower, yeah, we're going to see gold do very well. We're going to see silver do really well, and that's just kind of what takes place. So right now, very strong day, good looking reversal pattern. Are we going to get some follow through? That's the most important piece of all of this. So very important chart. Let me just go ahead and show one more chart of utilities. We mapped out this zone here that the price has been. Obviously, you see this just big ramp up. It's going into overbought territory, so it's likely to see some sort of a pullback in utilities in the short term. If what I'm saying happens, yields continue to move lower, more money flows to risk off, which I personally have been suggesting, even though the last couple of days the market's been ramping higher. It looks like, just to me, just a better move overall, just to be more risk off right now. Protect your wealth, protect your capital. This could be a very well a consolidation, and then potentially a move higher in this sector. So we'll keep an eye on it, but right now it is overbought. Some of my stocks today took a little bit of a hit, so I'll talk about that though on the weekly scan. All right, everybody, that is all that I have for you on today's video. I guess we can wrap it up with the conclusion, but I got to do it with Coco in my hand. So Coco wanted to say hello. All right, now as for the conclusion, where's my head in all of this? My head, what do you know? It still remains in uncertainty. It's not saying I want to go long here, and it's definitely not saying that I really want to go short here. Why wouldn't I want to go short when everything's overextended? It presents a great opportunity. Well, the reason why I don't want to do that is simply because we're moving into a lot of market uncertainty. We have the presidential elections, we have all the talks about vaccines, we have all the talks about stimulus. So if I do go short, it has to be a very small position because, you know, I could get very easily just blasted. Another method that I've been kind of considering are calendar spreads or some other advanced option strategies potentially. As of this particular point in time, I'm doing just fine looking for major areas of support and then buying into individual stocks that have been in a performing sector. So my personal take on the markets right now, it's, you know, pump the brakes, risk off, let things take place. Let these big aggressive moves happen. I don't want to be a part of them, but I will move into the momentum of the sectors I feel comfortable with. So that's all we got for you on today's market brief. It's probably way late at night right now when this gets out, but I really appreciate it. And if you haven't done so already, you know, like and subscribe. You know, it helps grow the channel. So yeah, talk to you guys later.